right. Hey, everybody. Happy Tuesday. We're here with I think this is going to be our third part of our interest rate series.
Yeah. And it's a road show now.
It's a road show. We're on the road. We're going to make a couple stops. First stop is here with a close friend and one of our favorite lenders in town, Brett Hartlaub with Prime Lending.
One of our favorite lenders in like the northwest part of, like southwest kind of part of town.
Yeah,
we like to have favorite lenders in Quadrant.
There's a sectional.
No,
Is that how that works?
Within this
hello, internet and world.
Yeah, this
whoever's watching.
Brett Hartlaub, Prime Lending, boys and girls.
Good morning.
Grant, you want to ask him the question of
I'll ask him the
talking
question.
about
As we all know, we're one take wonders here. One take, make it count. Here we go. And so, Brett, we have a great question for you today.
Awesome.
And we think it's about interest rates.
They're popular right now. I'm getting a lot of questions about those.
Yeah. So, what is it really that drives interest rates? Because we freak out when we see that the Fed's raising rates, or we look at the stock. I mean, we just freak out all the time. So, tell us, educate us, what actually drives interest rates up and down?
Absolutely. Let's actually start right there with what you're talking about was the Fed.
Okay.
I get phone calls every time the Fed moves the rate either up or down. Hey, the Fed just changed the rate by a half. Did my mortgage rate change by a half overnight?
Yeah.
No. There's no direct influence of the Fed controlling interest rates. They are a contributing factor, don't get me wrong. What that is referring to when the Fed changes their interest rates, that is the cost of money bank to bank, right? The cost of money to borrow from the Fed overnight, short-term loans. So it's the cost of borrowing money, but we know how costs work. They're generally passed on to the consumer. Yeah. So yes, it is a contributing factor, but we're not going to see a Fed funds rate change of 0.5% and the next morning wake up to mortgage rates 0.5% higher. In fact, this last change, rates got slightly better just because the market already priced it in. Anticipation is in the marketplace one of the bigger things.
That makes sense.
So that's one of the biggest factors that we see driving rates. But the very, very biggest factor, which everybody is seeing right now in the economy.
Is it the stock market?
No, it's not the stock market.
Inflation.
It's inflation. Ding, ding, ding. Grant with the winner. You guys are filling up your gas tanks. You guys are going to get food. I mean, a cheeseburger at a restaurant. You're going to get stuff at the grocery store. What are we seeing the cost of prices of goods and services?
Okay.
Gone up. Yeah.
Historically. They're going through the roof. All interest rates really are is the price of money. So as other prices are going up, that price is going up as well. The quick explanation on that is real wages. People are making more money in response to this. We hear about unemployment, supply chains, but real wages are going up. I mean, everybody's made the joke about how you can make $20 working at McDonald's now.
Mm-hmm. Yeah.
Okay. Well, if everybody has a little bit more money, the cost of goods and services are going to go up. I like to use the taco analogies because I love tacos.
And it's Tuesday.
It's
Taco Tuesday.
Okay. All right. If Matt has a taco truck.
Yep.
And everybody has $10.
Okay.
Everybody can get Matt's tacos.
Okay.
But Matt realized that he can make more money by selling his tacos for $20. Now, not everybody can afford those, but some people can, and he's still able to generate more revenue there.
Yep.
So that's the analogy of inflation, of driving those prices upwards is what's going on there. Okay. People have more money, which is in real wages, which is in theory, which is in turn driving up inflation. So inflation's the number one thing.
Does supply and demand influence interest rates at all? If there's more buyers in the marketplace, does that have an effect?
It doesn't really. No, it's a market. They're more based on bonds, like a bond market, like the stocks are. So they are a publicly traded market that moves every single day, hourly. Sometimes even we'll have interday price changes. But no, there's not. There's been historical. That's kind of a blip map. There's been historical supply and demand issues when there's been liquidity problems. That's when you go back to that, 2009, 2010 meltdown on Wall Street. But that's a whole nother subject for another day.
Okay. Yeah.
But no, we're not having any sort of supply and demand problems right now that are driving rates.
So okay, I have a follow-up question.
Absolutely.
Then. I read recently that the Fed, well, not the Fed. I'm sorry. That Fannie and Freddie were shedding their balance sheets. And so I know that through the pandemic and even before, really probably since 2009 and 10, Fannie and Freddie were the main buyers of mortgage-backed securities.
Great question.
So now that you're having to find different buyers on the secondary market, are they also contributing to rates going up because they want a higher return than maybe Fannie and Freddie do?
Absolutely. Okay. So when you think of a mortgage, you generally think of the end consumer taking out a mortgage on their house to buy one, right?
Yeah.
mortgages need to be looked at also a different way from the banking side of it. For example, a bank puts together $100 million of 5% notes and goes out and sells them to the market. So to keep their bank liquid so that they can go loan another, $500 million. They're always selling to the marketplace, right? They're always staying liquid, turning that money over. Mm-hmm. One of the biggest buyers over the last 12, 13 years now has been the U.S. federal government.
Yeah.
They are scaling back. They're still the biggest buyer. Don't get me wrong.
Oh,
they are still huge. It's, just because they're buying at a 90% or an 85% clip of what they were buying at. But that is forcing things up. So now banks need to go find investors to pick up that slack. Mm-hmm. Who else buys mortgages? Foreign governments, your 401k, hedge funds, different investment grades. Most people in their portfolio, if you've got a portfolio with an investment advisor, there's likely mortgages being held in there because, if there's a chunk of money, the chunk of the investment paying 5%.
Yeah.
But now, to go attract, like Grant asked, to attract more investors, what do banks have to do to rates?
Make them more attractive to those investors.
To make them more attractive to investors, and that gets passed on to the consumer, who we usually think about having the mortgage.
Gosh, I just feel like I went back to school today.
Yeah. This has been very educational.
Economics, mortgage economics 101.
It's good to have a pro on with us to talk about this subject.
He didn't offer us coffee, and he's drinking his, but that's okay. We'll forgive him for that.
And it's delicious.
Well, Brett, thank you so much.
Thanks for having me on, guys.
You guys, this, as Matt would say, this was just chock full of meat.
Chock full of meat this morning. Breakfast burrito.
Yeah, breakfast sausage, protein like you wouldn't believe. We hope you enjoyed it.
With some hot sauce.
Of course with some hot sauce, yeah. Hey, join us next week as the roadshow continues on our interest rate series. And until then, have a great rest of your week.
Thanks, Brett.
Thanks, guys.
Hey, thanks so much for watching today's video. If you haven't already, make sure to follow us on Instagram and Facebook. Our handles are shown here on the screen, and you can always find our contact information or more about us on www.buysellbend.com. Thanks.